This is Cece. Welcome to the Orbit. It is Monday, October 30th. We are a little bit into the trading day and stocks are higher. We've got the SPY up about 0.8%. The 0DT expected move was about 0.9%, almost 1%. So stocks have almost covered that on the opening gap, and they're kind of sitting right near the highs of the day. Now, that comes on the heels of a down 2.5% move last week in SPY, as you can see on that 1-week chart. So the market is trying to attempt a bounce here right out of the gates on Monday morning. Looking at the expected move for the rest of the week out to Friday, we're at about 1.6%. That was about just over 2% coming into the day. So it's contracted a little bit after a few hours into the week, but not by much. Now, this week sees a couple of big events on the economic calendar with the FOMC meeting on Wednesday. Rates are expected to stay the same, but of course there's a press conference with Powell afterwards. We have the non-farm payrolls number on Friday morning, and then we have a couple of big earnings events led by AMD and Apple this week, but a full earnings calendar all week. Now, switching quickly to the 0DTE move, for the day, we are at about, just call it about 0.5%. That was, as I said, closer to 1% coming into the day. So you can see how quickly that contracts during the day. That currently has levels at about 412 to the downside, 416 to the upside. Moving over to the Qs, and we're looking at a 1-month chart now just to get a sense of how this has been trading. You can see those past 2 weeks sharply lower. The market is attempting to bounce, but as you can see a week ago, the market also did this on Monday and then failed and continued lower for the balance of the week. This was a level in both SPY and Q that a lot of traders were pointing to as potential support. It sure didn't feel like that on Friday. Traders would obviously be looking for this bounce to hold. From a volatility perspective, we've got the VIX at about 20. It got as high as about 22 last week, which historically over, say, the last 8 or 9 months, you have seen buyable rallies, even if they were short-lived, when the VIX got to about 20. This is the first time we've really seen it go through 20 and kind of not really care that the VIX got to 20 and stocks not seeing an obvious bounce. Now, that it remains to be seen here. Looking at the Qs, we've got about a 2% expected move for the balance of the week. This was about 2.5% coming into today. And as you can see, it's up about 0.8% on the day. That expected move was well over 1% coming into the day. Not well over, but over 1% coming into the day. So, but as we've seen the last 2 weeks, you've often seen these 0DTE moves. They can happen in both directions. Last week was a pretty steady drift lower, especially Thursday and Friday. But the prior weeks to that, we would often see a move, if the expected move was 0.8%, you might see it in both directions. And in some of those really wild economic data release days, we actually saw it multiple times hit the expected move in either direction. But as a comparison over the summer in that low vol environment, you would be seeing expected moves less than 0.5%. Now you're seeing them consistently near 1%. So that gives you sort of a sense of how much more volatile the market is intraday. Switching back to SPY, let's look at a couple of trade setups here into Friday. So if we are just looking at the Iron Condor based upon where we see the expected move as of midday on Monday, you've got a lower short strike of 407 and an upper short strike of 420. Now, we talk about how you can lean these expected move-based trades into a bullish or bearish direction. Last week, if you had faded the opening Monday rally to a bearish setup, perhaps selling a credit call spread or even positioning in an iron condor or a butterfly or something along those lines lower, then you would have been, correct in fading that opening move. Now, the difference this week is this is a level that a lot of traders have been looking for some sort of bounce. So far, that bounce is weak, you could say, or at least it hasn't been proven out. So there's a couple of different ways that you could go here. In general, we've been looking at this the last couple of weeks with this volatility. One of the first things you might look at is just sort of expanding this a little wider, giving yourself a little bit more room to both the upside and the downside. So we took this a couple of strikes wider. We get a max risk of around 70 for a max gain of around 30. And that now gives you a little bit more on the upside. You can see where that lines up on the chart. It's basically if we retraced last week's move lower of about 2.6%. And then on the downside, it gives you room down closer to that big round number of 400. Let's just do a couple of directional leans here and see what we can figure out here. So let's say we were to give this bounce and this rally some respect and say there's a potential for the market to actually close higher this week and continue this morning's rally. Well, we would be taking this, and I'm just hitting the up button, giving ourselves a little bit more room, bringing that lower short strike to just a couple of dollars below the low we saw on Friday. And what you get is a real good sense with this updated expected move as it travels through the zone. This is clearly a bullish leaning iron condor potential income generating spread that gives you room to the upside for this bounce to continue throughout the week. The expected move to the bearish level, of course, would take you to a max loss. So this is really leaning in on that credit put spread side of this condor to be just below the prior lows. If this rally were to fail and the market were to do what it did last week, then this trade would quickly go max loss. However, and this happens a lot of times when you do see a reversal, a lot of people doing income generating strategies will actually the upside part of their condor, the bounces can be quite violent after a consistent sell-off, and they might be threatened on the upside. So this is one way to account for that. Say, I think this bounce might be real, at least for this week. Let me give myself upside potential where I don't get blown out on my call spread side of it. Looking the other direction, if a trader was saying to themselves, oh, this could play out just like last week where you saw stocks attempt to rally on Monday, faded, traders fade that move, it goes lower. An obvious big round number down below this level that we're at is down near 400. I think I've seen some traders pointing to 402 and levels like that in SPY. So now we're looking at a condor which we made it a little bit wider to account for this extra bit of intraday volatility and all of the things happening this week. And we set that upper strike up near the expected move, meaning that if the rally did follow through and it at least went up in line with the expected move, it would be right around our short strike. But then on the downside, we gave ourselves a lot of room for the market to disappoint after the Monday rally, go lower, setting a short strike at 400. And as you can see, again, risking somewhere in the $60 to $70 range to attempt to make somewhere in the $35 range.